they just don't have the time or the expertise to do the really in-depth underwriting, they hire me, and it's flexible, and I can either do by the hour, by the month, and help them get their deals done. So really, primarily, I come in after they've decided to pursue the project, so after feasibility, and they know they want to proceed, and they just really need to raise money, debt and equity. So that's my primary function, is to sell that piece of it and allow them to raise their needed capital. So we're going to be talking about some commercial real estate underwriting fundamentals today. And the super quick outline here, I'm just going to start with terms. It's boring but critical. And these I see really misunderstood in my industry by people that have been in it for a really long time, including developers, just slightly askew, and it could really throw the whole thing off. So I'm going to spend a bit of time just getting really clear as to what the terms are, and then a couple goals with regard to what you want to make sure your project looks like in the forecast before any money is committed. And then lastly, some modeling techniques, which is going to be super high level. And if we have time at the end, we'll jump into my model and look around for a little bit. But with that said, thank you, sir. I just wanted to start with this quote here, or this axiom. So finance is the study of money flows, and there are really three pieces: how much, which direction, inflow or outflow, and when. And that's everything under the sun of finance, really. If you know how much, which direction, and when, you have all the pieces you need to put together a financial analysis. So let's start with terms. And the first I'm going to go over is this concept of trended and untrended. I don't know if this is commonly understood, but really what untrended means is today's prices. That could be rents or operating expenses. Trended means the future, and the future is relative depending on when our leases are going to start, really. So as I mentioned, it applies to both rents and operating expenses. And if we're looking at an acquisition, trended versus untrended rents, let's say, there's a pretty small difference, right? If you're looking at a building where the average rent's $30 a square foot a year, and you want to acquire that building, next year's rents that you will be looking at are going to be very closely similar to those untrended rents. So it doesn't get too complex in acquisitions, but it does get complex for developments because we have such a long period of time between when we underwrite a project and when the rents really go into effect. So if we just look at a chart like this, it's kind of a standard bell curve. These are the months here. So just imagine the land is bought and a lot of the upfront costs are incurred for architecture, engineering, and so forth. Project is built, and by month 24, it's basically fully constructed. But then we need to rent the property up or lease it up. So this blue line here is occupancy. And by the time we hit our 95% target occupancy, that's 36 months after it broke ground. But we're underwriting it really 2 years prior in a lot of cases. So from the time we underwrite the deal to the time when we hit our target occupancy, that could be a 5-year span, during which 3% rent escalation could take rents from $40, maybe up closer to $50 per square foot, whatever the product type might be. So we really have to be careful in the way we're modeling our untrended rents and operating expenses versus the trended numbers. And recently, trended might not, if it's a couple years, might not look too different than untrended because a lot of developers are assuming no growth at all in rents. Really just depends. So the next term is levered and unlevered. And this really just means with or without debt. If it's with debt, it's a levered deal. If it's without debt, it is an unlevered deal. Whether it's levered or not, we typically want to compare it against the opposite case just to see what debt is doing for the economics of the deal. So leverage helps expose projects to upside, and I've got sort of a verbose example here, but just to walk through it really quickly. If you buy $1,000 asset, 50-50 equity and debt, and then it appreciates from 1,000 to 1,500, and you sell it, how much money did you make? Well, you make 500. You pay back the loan, and then you're left with 1,000. So you took $500 of your equity and turned it into 1,000. You made 100% return. You expose yourself to the upside in that case, because without the loan, if you would have just taken $1,000 of your own money, bought this asset, and then sold it for 1,500, you'd make a $500 profit on a $1,000 investment, which is a 50% return. So you could see debt took your 50% return and multiplied it or levered it up to 100% return. So if you did this across 2 deals, you'd have a lot more money than if you just spent all your $1,000 on one deal. The other thing debt does is it helps limit your downside. So let's look at another example, same exact asset, but instead of selling it for 1,500, you wait a year and sell for 250 because the market tanked or whatever. So in this case, it goes from 1,000 to 250, but you only lost $500 because you borrowed 500, and therefore the bank takes a $250 loss, you take a $500 loss. So you really did limit your downside in that case. So debt really helps you achieve a much higher upside in percentage terms, and it helps you limit your downside in absolute terms, which is pretty special as far as I'm concerned. Okay, moving on. So we've covered trended and levered so far. Let's talk about project cost. It seems obvious, but this one's actually kind of subtle. So it's not how much a project costs to build. It's not your materials and your labor and so forth. It sort of is, but really more accurately, it's the amount of capital required to stabilize a project. So what does that mean? Capital is debt and equity. How much debt and equity is required to stabilize a project? What does stabilize mean? Stabilize means it no longer requires capital, debt and equity to cash flow. It requires only income at that point to cash flow. And we might see an example in a bit of what that true distinction is, but suffice it to say, it's really how much debt and equity do I need in order to take a non-existent building or an existing building to a point of stabilization where I have to invest no more money in it. It just churns it out. So we have, just going back to our prior term, we've got levered cost, the cost with debt, and an unlevered cost, the cost with no debt. So if you were to acquire a building with pure equity, that would look different than if you were to acquire it with debt. And the reason is, so here, let's a $50 million unlevered cost basis if you were to just buy it with equity. If you buy your building, development or acquisition, doesn't matter, within a levered scenario with debt, the cost basis is going to be higher for 2 reasons. There are fees on that debt and there's interest on that debt. So that's often missed in a lot of the analyses I see. The assumption is the cost basis is the same in an unlevered and a levered scenario. It's not the case. You really do have to account for a higher cost basis in the levered cost scenario. Okay, I'm sure everyone's familiar with net operating income. It's revenue minus operating expenses, and generally it's used as the proxy for unlevered cash flow. So how much would the property produce in cash if there were no debt on the property? The exceptions are retail and office, because in those cases you're going to have tenant improvements and leasing commissions, stuff that on a financial statement falls below net operating income. But for simplicity, generally speaking, NOI is what you can use as your unlevered cash flow per year. So just as an example, green's revenue, red's operating expense. So the difference between the red and the green is the black, and that is NOI. We can see NOI in this case grows from less than 2 million to 2 million in year 4. This is going to become important in another example here. You can represent it this way. I like to represent it this way. where revenue is this top line and net operating income is the bottom line, and the difference is interpreted as operating expenses without having more visual data gumming up the screen. So I like this because people are, I think, more used to thinking of financial data in line chart form. It's been my experience anyway. All right, so now we've talked about 4 terms and they sort of all meld into this one. This is the first term that is really a financial return metric, and this is the most important one as far as I'm concerned. Yield on cost. So yield on cost is the return on project cost in a given year. So this will change year over year in the hold period, but typically we're gonna look at the first year as sort of the benchmark for the performance of the project. So the formula is net operating income divided by project cost. And how much money does the project produce before debt is even factored in, divided by how much debt and equity did we have to spend in order to acquire the building. You can compare this to a dividend on a stock or a yield on a bond, right? It's just, you buy an asset, it produces a return. What's the percentage return? That's just the same as yield on cost. So for acquisition, this is probably the most complex point I'm gonna make all night, but I have an example to really flesh it out. I don't define cap rates in this presentation, but we're gonna attempt to do it here. But for acquisitions, the buyer's first year yield on cost is the seller's exit cap rate. And here's the logic there. This is the same example from the previous slide. We're gonna look at year 4 here, where we have a $2 million even NOI. We're gonna pretend a sale occurs at the very end of year 3, okay? When a property is sold generally, it is valued on the next year's forecast NOI. So if the property sold at the end of year 3, we're gonna project out 1 more year, because that's what the buyer cares about.
Is that what normally, what they have the pro forma, whenever they have the what's it called? Like, you know,
The financial model will
yeah.
have a pro forma.
Yeah,
The offering memo.
yeah.
Yep, exactly. So,
Thank you, Joe.
Yeah.
so we care about that year 4
I leave now.
projected NOI. So from the seller's perspective, let's imagine they originally bought the building for $25 million. They've got a $2 million NOI. So we know their yield on cost, or YOC, in that end year is 8%. All we did is take the $2 million, divide it by what they originally bought the building for, and they've got a yield on cost of 8%. But in the market, let's say this is a multifamily building, the market wants 5% cap rates, right? So the buyer is looking at this $2 million income stream and saying, I will offer a 5% cap rate on that property. And all that means is they're willing to pay the amount of money that will give them a 5% return. So if they know they're gonna make $2 million in the year after they purchase the building with reasonable assurance, they know they're gonna make $2 million, that should roughly equal 5% return. That means they're willing to pay $40 million for the building. Pay $40 million, earn $2 million, that is a 5% yield on cost in their first year. So their going in cap rate is the same as the cap rate that this seller is going to sell it for. And their entry cap rate is the exact same as their first year yield on cost. Go for it.
Yeah, I'm just curious, like when a buyer calculates NOI for the next year, do they, like in current market, right, the interest rates are going up. For example, someone who bought it year 1 could be at 5%, and now in year 4 it's 8%, and then the value is going down. So do they still look at if I'm the buyer, if we are the buyer in this case, do you still look at 2 million NOI, or do you look at 1.5 million? Do you kind of calculate what's going on in the market because your NOI is going to be lower, and then?
So because NOI does not factor in debt at all, it's just revenue minus expenses, theoretically, interest rates should not affect it at all.
Right.
Right? maybe could, if interest rates get so high that it starts making everything less affordable, maybe that would put downward pressure on rents a little bit, and maybe upward pressure on operating expenses, but that's an indirect effect that is very hard to determine. But in isolation, interest rates will not affect NOI.
Okay.
Right? So the point is, whatever their going in cap rate is the same as their year one yield on cost. That's the relationship between yield on cost and cap rates. Okay, so now we're going to talk about yield on equity. If this is also known as cash on cash return, we'll talk about that shortly. But it's the return on equity for a given year. So yield on cost was the return on cost for a given year. Return on equity for a given year. Also known as cash on cash return. I like yield on equity more just because semantically it maps to the idea of yield on cost more intuitively, and I'll perhaps be able to explain that shortly. But basically, the formula is cash flow after debt service divided by the equity invested. So how does that relate to yield on cost? Here's the example. Yield on cost is NOI divided by the cost, and the yield on cost in this case is 8%. We just saw that in the prior example. The seller, when they sell the building, their yield on cost is 8%. But let's assume a $15 million loan that demands $1.1 million in annual debt service, that's principal and interest. What we do is we take our NOI, we subtract 1.1 million, and so what's left over is cash flow after debt service, and that's 900,000 in this case. So that's a different numerator. But then, rather than divide by our cost, we bought the building for 25 million, but we used 15 million in debt, which means we only used 10 million in equity, right? So our equity basis is 10 million. We're making $900,000 on $10 million of equity invested. So our yield on equity, or our cash on cash return, is 9%. That's higher than 8%. So in this case, we could say we're positively leveraged because we're making better returns using debt than we would if we were to use pure equity. That's hard to do nowadays. Generally speaking, this number is going to be lower than that, and it's because interest rates are high, fundamentally. But we'll talk more about the benefits of debt and how, even if you're negatively leveraged, it can still help. Okay, so this is our third financial metric, internal rate of return. This one's really not well understood in my view, and it took me years to wrap my head around it. But this is fundamentally what it means. It's the annually compounded rate of return on an investment over its entire hold period. So you typically don't look at IRR, as it's commonly called, each year. It's useless when you're looking at it by year. It's the average over the entire hold period. And for commercial real estate, your returns are often really low in the initial years, and then you sell it and you have this massive event, and that pulls the entire average up. So you really need to look at the whole thing. This is the common definition, the discount rate at which net present value equals 0. That's two more terms that don't make intuitive sense. It's my least favorite definition, so I don't use that. I think it's a terrible definition. The point is it normalizes irregular cash flows into one simple metric, and it's what you can use to compare to any other investment, really. Let's say you want to make 10% per year. 10% per year, so you invest $100, 1 year thereafter, you get a coupon payment of $10. Pocket it, you wait another year, and you make another $10, and you get your original $100 back. That's an IRR of 10%. You can do this in Excel. This would equal exactly 10%. $10 and then another 10 and your original principal or capital back. Another way to get a 10% IRR is invest $100, but instead of taking that $10 1 year thereafter, you reinvest it in that same investment. So you get 10 out, you put 10 right back in for a net of 0. Now your basis goes from 100 to 110, and you earn 10% on $110, which is 11. So by the end of year 2, you had your 10 from year 1, your 11 from year 2, and your original $100. That's $121 you get back. That is an IRR of 10% as well. These are the exact same result. So you can see it really depends on what you do with those intermediate cash flows. Do you put them in your pocket or do you put them back in to the investment? And with commercial real estate, it's seldom this clean cut where it's once a year.
Yeah.
The problem with IRR is it is based on an annual compounding. So that's what you have Excel for, because it will do that math for you and it will figure out what the equivalent IRR is. Okay, last term, I'm sure you're all relieved, is multiple on invested capital. So this is just the ratio of cash inflows to the investment amount. It's like a profit ratio, basically. It's also called EMX, which stands for earnings multiple, and then they throw that X on the end. So it's completely synonymous. So just as an example, 1.50 means you make a 50% profit. You put in 100, you get out 150. That is an MOIC of 1.5. So from our previous example, same exact thing, put in 110 and then 110. You could add these up, 120 divided by your original 100. It's an MOIC of 1.2. But in our second example, where we allowed that $10 payment that we would have taken and put in our pocket to compound, that's a 1.21 MOIC. So you can see it adds additional perspective. The IRRs in both cases were the same, but the MOIC is higher in this case. So the more you wait and let that money compound, the higher your MOIC is going to be, but not necessarily the higher your IRR is going to be. Okay, so this part's super straightforward. Just really, real estate investing is pretty chaotic, and it's not as easy as it used to be when inflation was just taking everyone upward towards great profits. So when I underwrite things, I'm really just looking for two things, basically. The first is super obvious. NOI should grow year over year, right? That's typically because your rents are going up. Even if your operating expenses are going up, your rents should be going up at least as much, if not more, so that you can peel away your NOI. And when you're growing your NOI year over year, your yield on cost is going up. So that's more money to distribute to owners each passing year. Everyone likes that. And then you can also refinance or sell for more than you bought it for, because as we know, NOI is really the basis for how you calculate the value of the property. So if your NOI is increasing each year, at some point you might have so much equity that you could just refinance, pull out a bunch of money, or sell. And it goes back to that having a spread, which we'll talk a little bit more about. But yeah, just quick chart, start with an NOI here. We want to grow it as quickly as possible and then cash out, or long-term hold if that's your thing. This is the second goal, and this is just 2 of 2 here. We talked about this already, but your exit yield on cost should be greater than the market cap rate. We're going to go over the exact same example here. This is called a spread, right? Same example from before. $2 million, we bought the property. This should say 8%.
Yeah, I was gonna say, I wonder how that changed.
Yeah, right. I copied these and then revised and did not get back to it. But this $2 million here, you bought it for $25 million. That's an 8% yield on cost, but you're selling it at a 5% cap rate. The spread between that means you're selling for $40 million what you bought for $25 million. So that really is the most significant event in the history of your investment, is that sale event, and you want to have a maximum spread between your exit yield on cost and your exit cap rate. That's really the biggest thing. You could be negatively leveraged up to that point, and that could make up for everything else that went wrong in your deal. Okay, so to the real meat of this presentation, the modeling piece. So lesson number 1 here is design the model and the underwriting process around the terms that we just covered, right? You want to have all 8 of those terms baked into the underwriting. And these talk to one another, right? You're gonna have an untrended net operating income, you're gonna have an unlevered yield on cost, etc., right? You're gonna have an unlevered multiple on invested capital. So I could make a matrix here that would be not fun to look at, but if you have your head wrapped around each of these 8 concepts, by the time you're building your model, you're, I think, gonna be on much better footing, because you're gonna know how to focus on the results. So lesson 2 is setting up your tabs. Tabs are just the sheets in the spreadsheet. We've all seen Excel files that are like 40 tabs and you have to scroll left and right. My least favorite thing, frankly, is having to navigate tabs. So for me, I like to keep it very Spartan and just have 5 tabs. 5 tabs total. You're gonna see I violate my own advice in my model, but I'll explain it.
Of course.
The home page, which is the thing that opens right when your user opens the workbook. And it's just instructions, maybe a quick primer, a link to a video, YouTube video, whatever. This is probably the least important, frankly. Second tab is the inputs tab. So this is where some people will disagree because they like to have different inputs on different tabs. Revenue on one and operating expenses on another. I like to have them all on one. And there are a variety of reasons for that, but the spatial constraints is a big factor here. I like to have to fit all my inputs on one page wide because it makes me be very thoughtful.
Streamlining.
Yeah.
Yeah, getting it to the cross a lot quicker.
Exactly, and it makes me not add more columns than are absolutely necessary to define the project correctly. I think that's one of Excel's chief virtues is if you use it right, it will constrain your options in the most helpful way. You can't, so we've all seen the page that you have to go left, right, and up, down, brutal.
That's a lot.
It should be up, down only when it comes to the inputs page. Okay, so the third page is outputs, and really all I mean there is the calendarized financial statements. Your operating statement, cash flow statement, balance sheet, whatever you wanna include. We're only gonna look at 2, but that's the year by year or month by month, side by side tabulation of all the key outputs of your model. And that's separate from the inputs. I've seen them combined, it ends up getting really messy. They really ought to be separate. Fourth is just a summary, a 1-pager, executive summary, whatever you wanna call it, but that is the place someone can go and not have to scroll much at all or at all to find everything they need to know about the high level aspects of the deal. And we'll look at the details of that. And then the 5th one, again, it's sort of like the homepage, not as critical, but it's nice to have a place where you can have lists for your drop-down menu to refer to, just the stuff that you don't want the user to really look at, but still drives the performance or the usability of the tool. So those are the 5 main ones, and really they're conceptual buckets, so you might have a couple of each depending on, and you'll see in mine that is the case. But let's talk about the inputs tab. So there are 5 components to the inputs tab, so 5 tables, if you will, and here they are, right? And we could talk about all the different variables here, and I'm not gonna dive too deep because I think it's gonna make more sense with an example when I open my model. But you need to define your unit mix. How many, what's the square footage, what's the rent, when are they going to lease, how much are they gonna escalate rents year over year, etc. Then we need our operating expenses. There's the controllable stuff and the uncontrollable stuff. The controllable stuff is maintenance and property management, the stuff that you as the building owner have some say over in terms of how much you're willing to pay for the quality of service. And then there's the uncontrollable stuff, namely, I'd say insurance and property taxes. There's only so much you can do there, especially property taxes. Project costs, so that's land, hard costs, and soft costs. You need to buy the land, you need to hire an architect and engineer, you need to have your construction budget punched in. You need to be able to tell the model when it's incurred as well. A lot of your soft costs and your land costs are all up front, so you have this massive spike in the first month of the project, but then all your hard costs get distributed mostly in a bell curve manner, is what I've seen. And you just need to be able to tell the model when to distribute and where those costs over time. So the fourth table is capital. Really, I'd say debt in this case is a lot more complex. You need to tell the model how much debt you're really gonna take out to buy or build the property and what it's constrained by. This gets really complex in a lot of cases, but you start with debt because that you want to leverage your property generally as much as you can, although some people have gotten into really hot water from over leveraging their projects. But if it goes well, debt's only gonna help. So you figure out your debt first, and whatever's left over, that's the amount you need to raise in equity. And then lastly is the sale event. Some people combine it with some other part of the model. It really should be a separate module because it is the biggest determinant of the success of the project. This is 70+% of the economics of the deal, the sale event, and of course everything that happens up to that point will affect the sale event, but it really it makes or breaks deals, and it is critical, I think, to have a separate table to show very clearly what the assumptions are that drive that all important event. Okay, so that's the inputs tab. Then there's the outputs tab. I don't want to spend too much time here, but it's really two things that I think are critical. One is the operating statement, and what does that mean? That's these 5 items primarily. Each one of these will have detail under it, right? You don't want to just have revenue. You want to have revenue from rent. You want to have ancillary income from parking and vending machines, whatever else you might include in that. You want to have vacancies to show relative to the gross potential rent how much you're not getting from having vacant units, and then any recoveries, whether that be like a ratio utility billing system or real expense recoveries in the case of an office or a retail property. All of that factors into revenue or effective gross income. Then you have your expenses, all the things we mentioned earlier. There can be 6 to 15 different expense line items depending on the complexity of the project. Then you want to show your net operating income, that's key. And then you're going to subtract your debt service. I like to show principal and interest. So if there's an interest only period, you're very clearly showing I'm only paying interest in years 1 and 2, and then year 3, we start amortizing, we got to pay both interest and principal. And then this very important cash flow after debt service. As we know, this factors into our yield on cost, this factors into our yield on equity. So it's nice to show those. So that's the first statement, and again, this is month by month, quarter by quarter, or year by year, depending on how you choose to design it, but that's what the operating statement is. It's the full calendarized version of the forecast. And then the returns, right? So the returns really, this is oversimplified, but you want to paint a picture, you want to tell a story in numbers, and the first thing that happens in your story is equity puts their money down, right? They start earning cash flow after debt service, right? That's what they're making. Equity doesn't make net operating income. They make cash flow after debt service. So they put money down, they're in the hole. They start filling that hole with cash flow after debt service for however many years. And then at the sale event, they're gonna sell the property, but they have to pay off whatever debt is on the books at that time. And that whole story produces the profit to the individual. So we might see small amount, small amount, small amount, small amount, growing but small, and then the final year is when everyone is made whole. So really just two, I have a bunch in mind just because sometimes it's helpful to show more detail than that, but these are the absolutely critical ones to show in your model. And my recommendation is these should be modeled monthly and then rolled up into annual detail. And I'll maybe get to talk about how to do that formulaically. It's pretty straightforward and dynamic. But modeling it by month allows you to explain, I think, most clearly and specifically to a banker or an equity partner what happens when, and then you can always, it's easier to smush data down into more vague than it is to try to open it up, right? So start with the most specific temporal time frame of monthly, and then you can consolidate from there. All right, and the last one we'll talk about here is the summary tab. So the first thing that should be on your summary tab, again, this is like the executive summary, the one pager that no one has to scroll left, right, up, or down to get. Capital sources and uses. So this one was pulled from my model. It's sort of a lot to look at, but here are the 6 major buckets of uses or costs, and then I've got 6 major sources of capital. And oftentimes a lot of these aren't filled, right? In this case, there's a senior loan and a junior loan, and then the rest is in equity, and that's paying for land costs, hard costs, soft costs, blah, blah, blah. And that number, total uses, should always match total sources. And if there's not, a delta between them should show up, but it should really always be 0. The second thing you'll want to show is some type of summary returns so that the investor reviewing this doesn't have to look very hard. And this is what it looks like in mine. I have 2 different sections here. The first one is when operations stabilize, what are the metrics that matter? There's untrended yield on cost, trended yield on cost, right? And so trended yield on cost should be higher if rents are going up. And then trended yield on equity. This deal, the yield on equity is miserable because debt is not helping. It's actually hindering the performance of the project. So if you just looked at this, you would say, I'd rather just not use debt at all. But of course, this is year 1, right? So, and then you'll notice there's levered and unlevered, right? So this is assuming no debt. Trended yield on cost and yield on equity for an unlevered project are the same because there is no debt. So that's the stabilized operations year 1. That's just sort of an investor's way of looking at, all right, when this thing no longer needs my capital, how does it do, right? And forget about the rest of the project. I just want to know in that first year how it's going to operate. But they also want to know the full project situation. They want to know, how much do I put in? How much do I get out? What is that MOIC, right? And what is my IRR? And IRR is probably the most important metric, right? Because what that says is if I put $1 million in and I don't see it again for 5 years, I know it's going to compound, or at least I believe it's going to compound at that rate. And someone savvy with the phone can punch that in and realize how much total money they will get out at the end.
So, question, the trended and untrended,
Yep.
YLC, YOE, that's assuming you have the equity in-house and you don't have to raise capital, because there's costs to raise capital, right?
That's right. Yeah.
Because that would go then lower,
That's
mirroring
right.
more of the debt side,
Yep,
if you have to pay investors a
exactly.
return on the equity raised.
Yeah, and that
Okay.
does complicate things for you, but
Okay.
yep. So that's the second piece. So sources and uses, a summary returns table, and then the third thing, which is really a catch-all, is just visualizations, right?
I had to do it.
So everyone likes charts. They communicate a lot in a little space, and rather than looking at a forecast, an operating statement with tons of rows and 10 columns, you can just see like, okay, I see what my revenue does, I see what my NOI does. Oh wow, after paying my debt, it looks like I'm not really gonna have much to pay my equity until year 4 and 5, right? It consolidates a ton of what could be confusing into something very obvious. So I have a lot of visualizations in my model, and sometimes they can be a bit much, but I'm a big fan. So to me, that's kind of the holy trinity of what should be in your summary. And again, I'm just going to go back to this axiom here. In finance, it's the study of money flows, how much, in or out, and when. And your model, if it answers those questions, will have done its job. So thank you.